Do you want to know how to trade options? In this video, I'm going to show you everything you need to know to learn to trade options. In this video, I'm going to be explaining options in Robinhood so every beginner could follow along and understand and practice within the app. An option contract is an agreement between a buyer and a seller to buy 100 shares at a specific price. Each one of these is a contract. This is the price of each contract. Below it is how much percentage it's gained within the last trading day. Percentage to break even is how much it needs to go up for you to start earning profit. And then it even gives you the break-even price so you can know when you'll break even. Each one of these contracts will make you money if you buy it and the stock goes up. Contracts below the stock price have more value and are categorized as in the money, meaning anyone who owns those contracts earn more money because of the delta, which I'll explain a little later. But the deeper in the money you get, the more money you'll make. Out of the money is any contract that's above the stock price. At this case, the stock price is $436.78. So anything above that is going to be out of the money. The contract right above the stock price is called at the money. Okay, now for the sake of this video, we're going to compare three contracts side by side. We're going to compare an in the money contract, a out of the money contract, and a at the money contract, so we can see the difference between these. One big difference is the delta in each contract. Another big difference is the volume and the open interest. As you can see, there's a lot more people on the in the money contract than the out of the money contract. Let's talk about the price value of an option contract, because it could be broken down into two components: intrinsic value and extrinsic value. Intrinsic value is the portion of an option's price that is based on its immediate value if it were exercised or settled immediately. For call options, the intrinsic value is calculated by taking the difference between the underlying asset's current price and the stock price. If that difference is positive, for put options, the intrinsic is the difference between the strike price and the asset's current price. If the option has no intrinsic value, the intrinsic value is zero. Extrinsic value, also known as the time value or option premium, this is the remaining value of an option's beyond intrinsic value. Extrinsic value is influenced by factors such as time to expiration, volatility, interest rates, and dividends. As mentioned earlier, it represents the market's expectations of potential price movements in the underlying asset and the possibility of option gaining intrinsic value before expiration. Extrinsic value can vary significantly and can contribute to the total price of an option. That's why it's very important that you get time when you're buying your contract. Here's an exact diagram of how the pricing is divided. So if you want to find the intrinsic value, what you do is you get the stock price and then you get the strike price from the contract. You subtract the difference and that's your intrinsic value. Then you get your intrinsic value and you subtract it by the option price and that's your time value. Now, when you buy an option contract, you're going to get a graph similar to this. This will move depending on how the stock moves. The price of the contract will fluctuate. Now, be careful with the IV, because the IV and the Vega can impact the pricing of an options contract. Once we start getting closer to expiration, it starts dropping significantly. Now, before options, the only way you can make money with a stock was up, down, and stale. But with options, you have more options in how you can make money with a stock. And I'm not going to go into too much detail about it, but for the most part, you can make money with different strategies once you get to understand how options work. Now, for you to understand how options work, you have to understand how to read an options contract. Now, here we have XYZ. That would be the ticker symbol. January 70. That would be the expiration date. We know it's a call, and then we know the premium paid for the contract. Now, if you join a membership, any membership where they do stock alerts, typically what they'll do is traders will send out what they're buying and they'll send it out using this format. Now, buying puts is almost identical to buying calls, except the in the money for puts is going to be above the stock price, and anything below the stock price is going to be out of the money. When it comes to puts, you want the stock to go down. So it's important that when you do buy puts, you want to buy puts when the stock is at a high point, and vice versa. You want to buy a call when the stock is at support or a low point. Okay, guys, the last thing I'm going to talk about is if you are going to trade options in Robinhood, I highly recommend you use a charting software. I like to use TradingView because it offers indicators that I could use that help me locate a good buying point and a good selling point when trading. And that's arguably one of the hardest things in trading, right? Is finding that good opening to make a trade. Now, with a good charting software, they will give you the tools that you need to find that and make it easier. I have made more money using TradingView and using specifically this indicator strategy drastically. As soon as I started using this strategy of the MACD and the alerts, I was able to make more money. And I know it sounds like an ad, but it isn't. But when making a lot of money, you want to try to make more, and that puts more risk. Correct way. I know options can seem risky and it can kill your account really easily if you don't know what you're doing. Even if you do know what you're doing, it's very easy to lose everything that you're putting onto a bet. So every time you use options, I want you to understand the risk. If you are going to buy a call that's $100, be prepared to lose those $100. As soon as you buy the option contract, just picture those $100 lost. This is going to help you cut losses, because once you see that you've lost $50, well, you've already accepted losing 100, so you have no problem with losing 50. Keep a long term where you have all your money and your funds at, and then use options on the side. Play small contracts until you understand how to read the market better. Once you understand how to read the market better and how to control your emotions in trading, then you'll be ready to trade bigger trades and learn more complicated strategies. If you want to learn more complicated strategies, or you want to learn more about option trading and you just feel like you are really interested in this topic, subscribe to my channel. I make videos on option trading for beginners, and I talk about every strategy that you could learn and you could use to make money in Robinhood, and a lot of gems out there that you probably would appreciate if you do want to become a successful day trader or just trader in general. Thank you all for watching. We're about to hit 15,000 subscribers, 16,000 subscribers. Let's hit that number. Make sure you subscribe so we get there. And that's it, guys. Thank you all for watching, and hope you all have a blessed day.